Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with Wayne Himmlestein. He is the Chief Investment Officer and co-founder of Logica Funds. Very interesting guy, great investor. Can't wait to talk with him. In the mailbag today, 2 Logica H questions and Moby Dick. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, let's talk about cargo cult investing. That and more right now on the Stansberry Investor Hour. So what in the world is cargo cult investing? Well, when I talked about Wayne Himmlestein, who we're going to speak with in our interview today, I mentioned Richard Feynman. I think Wayne is the Richard Feynman of quantitative investors. Richard Feynman was a famous physicist. He was the guy, he's most famous for being the guy who figured out what brought down the Challenger space shuttle. And if you Google Richard Feynman Challenger space shuttle, you'll find the whole story. And it was a very ingenious little demonstration that he gave. So he's just a famous physicist, and he's got a lot of books that I highly recommend. Anything written by Feynman that you can find on Amazon, I would definitely recommend it. And today, we're going to talk about a story that he tells that's reprinted in a book called The Pleasure of Finding Things Out, the best short works of Richard Feynman. And the story is, it's this cargo cult story, okay? And the cargo cult people were sometime after World War II in the South Pacific, on some of these islands, apparently, there were these, what Feynman called cargo cult people, these natives who, during the war, they had seen airplanes landing and unloading huge amounts of various, food and clothing and other materials for the war. And sometimes they saw them drop from the sky, on parachutes and big boxes and things. So when the military left, the cargo cult people, they wanted this to continue because they benefited from some. They got some of the food and some of the other supplies. And they wanted this to continue. So they cleared a space like a runway, and they put torches on either side of it like runway lights. And they would have a man in a little hut that they built, and they made little, coconut headphones for the side of his ears, and then they'd have like a little fake microphone in front of him made out of bamboo or whatever. And everything was perfect. Everything was exactly the way they had seen it. They imitated it all precisely. But as Feynman points out, the planes didn't land. It didn't work. It wasn't real. And most of the time, and Feynman's point about telling the story was, he says, real science, you're not a cargo cultist. You're really finding out and really understanding things. And it's really hard. Being a cargo cultist is easy because it's fake. But being a real scientist is really hard because you have to, he says the most important thing is not to fool yourself, and you're the easiest person to fool, right? Just the human tendency to want to fool yourself. So being a cargo cultist means you're kind of fooling yourself, and you don't understand that you don't understand that what you're doing is not going to work. And I think there are a lot of people in the stock market like that. In every mania, in every bull market mania, there are people who go through all the motions, right? Well, they get a couple hundred or a couple $1,000. They open an account. Well, great investors have accounts. I'm opening an account just like them. I'm putting my money in my account. I'm buying stocks just like great investors. I'm selling stocks just like great investors. You're doing everything the same. And maybe you're even making money in a bull market, right? You're buying and selling usually pure garbage, right? You're buying and selling Tesla and AMC and GameStop and all kinds of other garbage. And it goes up and you sell it and you make a lot of money. And you keep buying it, and you keep selling it, and you keep making a lot of money. So, hey, it's all the same, right? You're doing it right. Well, no, not really. Because, what the cargo cult investor usually gets wrong is that maybe the fundamentals of the businesses that they're buying pieces of, right? When you buy a stock, you're buying a piece of a real business. The fundamentals may not matter. They may not matter for years at a time, but eventually the fundamentals are the force of gravity. And you can buy an unprofitable company and you can make money owning it at 10, 20, 50, 100, 200 times sales when it's not making a penny and burning 100 million in cash a year or something. You can do that. And for as long as you can do it, it's great. But eventually, the fundamentals will act like the force of gravity, bringing that share price plummeting back to earth. And you'll find out pretty quick that sitting in the little bamboo hut with the fake coconuts on the side of your head is not the same as actually communicating with a real airplane that drops supplies, right? Same thing. And I think the cargo cultists have really they've actually not done well so far this year. A lot of the tech stocks, a lot of the NASDAQ components, we'll just pick on that as an example. A lot of them fell more than 50%, and half of them fell like 50% or more, or maybe it was even 60%, something like that. So a lot of these like growthy, unprofitable companies that they were considered no-brainers because they were changing the world or whatever, but not making a dime and burning cash. A lot of those have been penalized. They've been crushed. But so far, the big indexes haven't really been hurt that much, right? So somebody's still buying something, and stocks like AMC and Tesla and GameStop, they're still exorbitantly overvalued, just crazy overvalued. And eventually the force of gravity, the fundamentals of those businesses will find them too. And the cargo cultists will be revealed for what they are. Now, most of the time, that's why you want to hear the cargo cult story, right? Because you're trying to fake it till you make it, and then the market finds you out and penalizes you with losses. The problem is we human beings learn by imitation. Now, it's interesting. I think Feynman, it was as a scientist, he was right to point this story out and say, don't do that. Because in science, you can't fake it for long, right? Or maybe you can fake it for long, but you will get found out because the laws of nature will find you if you're faking it. Other things in life, though, aren't quite like that. Anything where there's this big human element, like in the market, in the financial markets, it's different. There's as much art, it's more of an art than a science, right? So it's weird. It's weird, this cargo cult thing, because we all start out kind of faking it until we make it, I think, in the stock market. I mean, who didn't make their first investment being entirely clueless and not having any idea what they were doing? We were all cargo cultists in the beginning. The challenge is to not be that as soon as possible, to be informed and to engage in a lifelong process of learning. So yes, if you're just starting out, you're faking it, but you got to continue doing that until you make it, until you really become a seasoned, experienced, successful investor. It's a story worth knowing, and it's in The Pleasure of Finding Things Out by Richard Feynman, the best short works of Richard P. Feynman, that book is called. Or I'm sure, you could probably Google it because the story is part of his 1974 Caltech commencement address. You could probably Google that or something. Or Feynman cargo cult story. And Feynman is Feyman. N-M-A-N. All right, well, that's all I want to say about that today. Let's talk with Wayne Himmlestein. This guy is so interesting. I can't wait for you to hear what he has to say. Let's do it right now. One of my biggest fears I'm seeing right now from readers and podcast listeners is that there is no money left to be made in the U.S. stock market, that the extraordinary gains of the past decade are gone for good, and that anyone over the age of 50 who's depending on stocks for their dream retirement is out of luck, destined for pain ahead. Look, I'm about as bearish as they come right now, but with the right information and recommendations, it simply does not have to be that way for you. This week, you have a very rare opportunity to get a free stock recommendation from one of the greatest investors of the past century, Marc Chaikin. Marc actually created one of Wall Street's most popular indicators, a system that appears in every single Bloomberg and Reuters terminal in the world and is still used by hundreds of banks, hedge funds, and every major brokerage site. He's traded through 9 bear markets, helped create 3 new indices for the NASDAQ, and has appeared numerous times on Fox Business and CNBC's Mad Money, where Jim Cramer once said he's learned to never bet against him. So when Marc issues a new big prediction or a free stock recommendation, it pays to listen. He says that while things are about to get much worse for many stocks in the market right now, and I agree with him, you also have an extraordinary chance to double your money from here on a very specific group of stocks that have barely even faltered during the recent volatility. No matter what's happening in the broader market, I always pound the table on the unique stocks that can protect and even grow your wealth in times of trouble. They're rare, but they're out there, and that's exactly the kind of stock my friend Marc Chaikin just gave away. This is a simple, free way to put a little money to work for your future. So don't delay. Head to 2022marketwarning.com and get your free stock recommendation from Marc. Again, you can access everything at 2022marketwarning.com. All right, it's time for our interview once again. And I'm really looking forward to this one. To me, this is very exciting. I think we're going to learn a lot today because our guest is Wayne Himmlestein. Wayne founded Logica Capital in 2011 and is currently Chief Investment Officer for the firm, responsible for leading portfolio management and the overall implementation of their investment strategies. Wayne is a member of the Investment Committee and Risk Committee, beginning his career as a proprietary trader in 1995. Been around the block a few times. And launching his first hedge fund in 2000, Mr. Himelsein has over 25 years of industry experience and graduated from the University of California, Berkeley. Wayne, welcome to the show, man. Really glad to have you here.
Thank you very much. Glad to be on.
So, Wayne, I have a confession to make. I hemmed and hawed before inviting you on the show because I've been to the Logica Fund's website, and what you guys do seems so sophisticated and technical. But the reason I invited you on is because I follow you on Twitter, and I'm telling you, to our listeners, I'm telling you, you have to follow Wayne on Twitter because he doesn't post like every single day a lot, but when he does, it's a really nice nugget about trading or mathematics or quant fund management or whatever. And it's that is really why I invited you on. I thought, wow, this is the guy. This is the guy. Also, I've seen you in Real Vision. I was like, this is the guy who won't be a jerk like Nassim Taleb if I have questions about quant funds. So welcome to the show with that.
Thank you. What a nice introduction.
So I felt like a good place to start was maybe coming out of something I and our listeners sort of are more oriented to, and headed towards what you do. And so I've got my trusty copy of The Intelligent Investor here, and when people talk about advanced mathematics, using advanced mathematics to manage money and make investment selections, I always think of this passage, and maybe you already know it. And he talks about this is Benjamin Graham. He says, mathematics is ordinarily considered as producing precise and dependable results. But in the stock market, the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions we draw therefrom. And then he says some other stuff, and he says, wherever calculus is brought in or higher algebra, you can take it as a warning signal that the operator is trying to substitute theory for experience and usually also give to speculation the deceptive guise of investment. And if I wanted to counter that, I'd probably just show everybody Jeffrey Zuckerman's book about Jim Simons, who would say nonsense, right? But you seem to cut it right down the middle. You're a quant guy, but when you remark about trading on your Twitter feed, it sounds very familiar. There's a lot of familiar sounding stuff there. So if we were talking in a bar and I said, what kind of investor are you? What would you tell me?
Yeah, that's a really good question. I like the way you put it. I cut it right down the middle. To say that mathematically, I divide by 2, right? So, or I take the average. If somebody asked me in a bar, I'd say definitely I'm a quant investor or a quant trader. That's typically my answer. And of course, to your point or to your question, that can mean a lot of things, right? There's the whole spectrum of quant. I very much agree with that verbiage in the quote you just read in The Intelligent Investor, and I've tweeted about that a lot, right? There's oftentimes the aesthetic of high mathematics and lots of formulas is oftentimes just a mask of we don't really have great theories, but we do a lot of complex stuff, and so a lot of times that's to be highly discounted. But then, to your point, to both of our points, you come across something like Renaissance or D.E. Shaw or any of the major quant firms out there, and they're very wisely using mathematics, right? So where is this happy medium between the two? And that's something that I think about a lot because I love math. I love a quantitative approach. And yet I see that the more variables you add, the more precise you try to make it, given the I'll call it nonlinear dynamics of markets, or the let's just use English here, the weird behavior of capital markets. The math doesn't apply the same way it does to, for example, things in nature, right? To physical properties of the real world, right? Or I should say of the natural world. So to find a middle ground there is to say, what I interpret is that math is a set of tools. And the process should be first have a theory, first be a trader, understand the way markets work or what the edge it is that you're looking at, or the thesis that you come up with. And then you use your box of tools and say, okay, should I use a screwdriver or a hammer, right? And if the hammer is linear algebra, then use the hammer, because that's the tool you need to bang in a nail. But if there's a screw there, then don't use a hammer. Get a screwdriver. So you need some calculus, right? And in that way, I feel like once you have an idea, once you've got a feeling about how to trade from a human perspective, math can be an amazing way to quantify your boundaries, your risk measures, and perhaps the behavior of your portfolio. It's certainly not an all-in solution and can tend to do the wrong thing if used solely without the necessary thinking behind the process.
Okay. I just want to look at this one tweet because you said something in it that it sort of overlaps with something I've said, which is that investing is very personal. And you came out and you said, we trade our personality. Optimists seek good longs, pessimists seek good shorts. Our style stems from who we are, but from there we add necessary rules and grow, or else we lose and quit. So I guess the way you do things, this quantitative way, it just feels right to you. In other words, this is not.
Yeah, I mean, it's exactly that tweet. I couldn't have said it better other than my own words, right? Which you just read to me. So thank you for reminding me how I said it. Yeah, I mean, exactly to that point, my personality is one that I love math, so I can't not use it. I can't not see the beauty or the mathematical pattern or relationship in some behavior. I see a behavior and I'm like, oh, that feels like blank, right? And or that that seems like I want to use some sort of this type of equation to hone in on how I want to deal with that, right? So that's my natural way. That's my quote personality. I'm an analytical person. I'm a quantitative thinker. I remember. I'll go back to a situation in my life. All my life, I've thought like that. This was kind of really funny. When I was young, I was maybe, I don't know, 9 or 10 years old, and my parents put me in a tennis lesson. And so I'm there playing on the court, and the coach is showing me how to hit the ball. And he's like, okay, when the racket comes here, and as he's like talking, I'm like, oh, of course, you want to hit it where it's at the maximum right there, right? And it's like, I saw that inflection point in my mind. I saw the curve, and I'm like, of course, that's where the most power is. And kind of before the coach or the teacher finished saying it, I said to him, "That's the point." And he's like, "Yeah, that's exactly." I'm like, "Well, that makes sense. That's the top of the curve of the racket." And so that way of thinking, if you will, was my personality. I was born that way. I can't extract it from myself. Therefore, as much as I want to do that, or as much as I want to be different, I'm not going to. And I guess going back to trading, when I went to a trading desk, I started trading manually. I started learning the markets as we'll call it a typical trader without quant. And then, of course, came my personality and said, well, that looks like that. And so you start infusing yourself or who you are. And if somebody is not a math person, they could equally do the trading, and they'll have people call it gut trading or instinctive trading, right? At the end of the day, it probably is some form of pattern recognition in their brain, but that's not how they feel about it because they're not a math person. Well, that's fine. But that is generally how I see the markets, how I see the world. So therefore, that's how I do things.
Cool. I want to go ahead.
And I guess one more thing. Oh, sorry. Go ahead if you're going to say something.
You said one more thing?
Yeah, it was just about, other people's personalities. What's funny to me is people get really not aggressive, but rigorous about their view, right? If somebody, for example, is not very mathematical and they deeply believe in the fundamental understanding the company and talking to management and the whole other side of the world of investing, very Graham and Dodd, et cetera, then I've seen in that framework looking down on the quant side, like, oh, that's nonsense, right? Or each other calling that. It's like this, that the two worlds have to be bifurcated. And in my view, it's just everybody's entitled to be who they are and trade that way. And you're going to do better being yourself. Why do you have to speak or look badly at the way other people choose to express their personality in the markets?
It is the strangest thing. I completely agree. Why do you have to tell me I'm an idiot because I came at investing from a value investing perspective? I agree with that. It doesn't seem to serve me at all. I don't get it either. But I want to talk about exactly the type of focus that you have, which is anybody can go to logicafunds.com and read your investment philosophy and about your strategies. But it's
Sure.
Correct me if I'm wrong, it is generally accurate to say that most of the folks, and I know most of the folks listening to this, they are what you might call short volatility. They buy stocks and they buy bonds, and maybe they do the odd options trade here and there, but they're mostly short volatility. And you, generally speaking, as I understand it, are pretty much on the other side of that. That's where you spend a lot,
Yes.
Now, the thing that gets me, if I read the stuff on your website correctly, you have this viewpoint that, like, when I think of long volatility, I think of people who are basically hedging. They're buying some out of the money put options, but they own the equities on which they're buying the out of the money put options. It's like protection. But what I got from reading your website was that it's almost like you were saying, no. There's volatility in the market, and you don't have to have this portfolio that's partly short volatility, in order to keep from just constantly degrading in value, right? I think I'm getting that right.
Right.
I found that fascinating.
Yeah, generally, yeah.
Given the sort of upward, over long-term upward bias of the market and how hard it's been to be short the last 10 years, mostly, maybe not the last 10 weeks, but the last 10 years for sure. This fascinates me, Wayne. It really does. And you started in 2011 at Logica. So have you been focused long volatility the whole time since 2011?
Yeah, I mean, so first, to be fair, with 2011, we started in December of 11, so God, it wasn't the whole 11, but let's say, yeah, roughly. But of course, it formally it was 2011, but it's the end of 11. So 2012, really, we started digging in and researching. To be fair, not that it makes a difference. It's just funny. I think of it. It feels like a whole nother year, but it wasn't. So for the most part, we started out with this idea. Yes, long volatility, I'll answer you, has been a focus of mine for even before 2011. Going back for, in 2000, that my first hedge fund launch was a long vol approach to statistical arbitrage. And if that it makes any sense, it was most stat arb is mean reversion focused. If stat arb, the thesis generally of stat arb is statistically two names might look like they're separating that have historically traded very similarly. Let's say like Coke and Pepsi. And so as they diverge, the stat arb says, well, if they're 2 or 3 sigmas apart, they should drift back together. And there's different ways of determining how, quote, far apart they are, different mathematical tools to use, co-integration or et cetera, et cetera. So that mean reversioning approach is short vol to some extent. And I looked at that and thought, well, I want to be on the other side of that as a, I don't know, contrarian thinker, just the way my mind worked. And I saw that in every portfolio of pairs, Cokes and Pepsis, and hundreds of them, there were always names that kept on drifting apart and said, well, why isn't anybody taking advantage of those anomalies that continue? And so I called it mean expansion stat arb. To try to find those pairs that were more likely to continue diverging and go long that spread, right? And so take the other side. And the other way to think about that is overlaying like momentum with stat arb, if you will, right? If something's strong enough, it's not going to revert. Anyway, so that was going back to the late 90s. That's where I started, right? So you asked me, was I always long vol? Yes, my way of thinking was always in that expansionary long vol view, right? So shoot forward to 2011, 2012, when I started Logica. I started it to figure out how to be long vol more consistently with optionality without the necessity to short vol, right? And because I found that most long vol players, to pay for that long volatility, will take on short legs, right? And so that's the very traditional way to pay. And there's put spreads. There's not just long puts, right? And that's, of course, it makes sense because the short vol carry pays for the long vol position, right? But from a pure long vol perspective, I viewed that as counter thesis, right? You're doing literally the opposite of what you want to be doing to achieve your goal, right? And if the example I love to, yeah, right. It's kind of funny. I have this great analogy I always use for that is that if you want to do the high jump, you don't put on a weight belt, right? Your goal is to jump as high as you can. You take your weight belt off. You take everything out of your pockets. In fact, jump naked if you can. Your goal is to jump as high as you can, right? So with that idea, the years 2012 through about 2015, 2-3 years of R&D, we dedicated without outside capital, just with a team of us, myself, and some other quants, of how to solve this problem. How do we be solely long vol without the necessity to take on a counter thesis trade to do so? And then once we resolved how to do that, we started trading outside capital with that idea, first as a risk overlay and then eventually launching our own funds. So yes, it's always been the way I see the world. And it took many, many years to figure out how to do that in a way that could be sustainable, exactly to your point, given that the market just continues to grind up year after year. How do you stay in that position in a pure 100% gross and net long vol position? It took a lot of time to do that, to figure that out.
So, Wayne, please don't be modest when you answer this question. It sounds like you invented this. It sounds like are you the pioneer of this? Of strictly long vol, not having to put on the counter the short vol position, not having to be long stocks, if you want to be long vol too. Are you the pioneer?
Listen, I mean, I'd like to think that sounds wonderful. I'm sure someone before me, I'm sure people have done it. At prop desks at big banks, I know there's been what's called gamma scalping, which is something that we do. I know that exists. So I think I'm probably, although on the other side of that, I have never seen a fund or another competitor or peer of mine that does what we do, or does it the way we do it. So in that way, we're a pioneer of this unique way of approaching this problem. That's for sure. And for sure, 90 something percent of our peers or competitors or the others out there are doing spread trading, are shorting vol legs to pay for long legs, right? Whether up and down strikes or across the calendar or term structure, there's all this short to pay for long, which because it makes sense. So yes, we are pioneers in saying, you know what, we're not going to allow ourselves to do that. And in a way, I look at it like, I tied one hand behind my back and said, all right, now how do I play the game, right? And I don't know that anybody sat down and said, I'm going to do that, because why? It's hard, right? But I did, I guess, to step out and be proud is we took on a challenge that we believe few have taken on, and very proud to say that we achieved a way to do it. And so, yes, we are somewhat of a pioneer, although we certainly took pieces and ideas from what has been done before, because probably everything's been done before in some way or in some magnitude. And it's kind of putting it all together that makes it special, obviously, over time.
Right. It also makes it highly unlikely that anyone listening to us is doing anything remotely like it, which I think is cool. I was hoping that this would be a learning experience, and it already is a wonderful one.
Yeah. And it also makes it that we don't look like or behave like others out there, even in our own peer group. Like it's one thing to not be correlated with the broader markets or with long equities, right? But then to not be so correlated with most other hedge funds is also nice, right? It really helps. So doing something so different, even though it's harder, it has its payoff, which is you get a really interesting pure alpha source or return profile that doesn't look like most others because they don't do it that way.
Yeah, and a decade on, you're still in business, and that's something. I mean, I feel like 10 years is a milestone these days, especially if you're doing something totally brand new like this. So I don't know if Jeffrey Zuckerman, the guy who wrote the Simons book, hasn't started bugging you yet, maybe I will. I mean, if you become a gazillionaire like Simons, I mean, I got you right here. I should be taking notes, man.
Thank you. Yeah. I mean, 10 years, you're right. It's a long time, and time flies. It's amazing when I look back, and I was like, wow, just, the first 3 years were just research. And I like that, that felt like it would never end. And then we got an opportunity once we had something developed. We weren't quite ready yet to launch our own fund, but we had an opportunity to run our long vol approach as a kind of a risk overlay against a broader portfolio of other managers, right? So we got to test it. I call it like proof of concept in real time with real capital to see, hey, did all the stuff we developed in R&D, can it actually do what it's supposed to do in the real world against portfolios that have the opposite exposure? And that itself took another 3 years, right, to prove itself, because you got to wait for not only markets to do what they do on average, you got to go through a few correction phases, right? I remember August of 15, the market corrected about 10%, and then January of 16, and then Feb of 18. And each one of these, I was excited because I'm like, oh, good, it's another event. It's another proof of concept moment, right? And after enough of those over enough period, you're like, okay, now we can go out and launch a fund because we've seen it through some environments. It's just amazing when I look back and look at really building something robust is never an overnight process. It's years and years, and it's especially when what you're building is a function of rare events, right? Because then you need to wait for them to actually see that it works. Right. So it's just interesting. And you say 10 years, and it's like I say to myself, wow, it has been, but that's what it takes to do something like this, I believe, sometimes. Sure. So anyway.
Yeah, sure. By definition, that robustness in this type of an endeavor must be built over time. So I want to go back to your Twitter feed, if I could, because there's a juxtaposition.
Please.
I think it'll appear a juxtaposition to our listeners that I'd like to talk about a little bit. And in one tweet, you say, over my 25 years in the game of quantitative investing, drenched in equations and models, I've honed in on the only math that really matters: minimize drawdowns during unfavorable times. The multiplicative nature of positive returns during good times does all the rest. I bet that sounds very familiar to our listener. We're constantly talking about minimizing downside. And yet there's this other thing. You said you're unwinding a quant myth with this tweet. You said, our best efforts are not necessarily in the hunt for new or better signals, but in digging deeper inside familiar ones. And I thought, that is interesting to me, because what little I know, about this stuff, I get from, the Zuckerman book or other books and things, Taleb or whoever, or your website. And I'm constantly hearing, like, even when we interviewed Jeffrey Zuckerman, he says, they complain a lot about the signals not working as long and not, having to find new ones. But when you say your best efforts are in the hunt for digging deeper inside familiar signals, can you tell me about that in contrast to what I said about, how the signals, like, people are constantly telling me the old signals don't work? What's going on here? What am I missing?
Yeah, so this is very much analogous to how we're bifurcating originally when we were speaking, like the use of math versus manual trading or gut trading, right? It's both work. It just depends on who you are, right? So there's an answer that brings two opposing worlds together, right? So in this one, yes, there can be and is signal decay. We'll call it that, which is that people find a signal, an inefficiency, an anomaly, whatever it might be in the market, a pattern. And of course, there are hundreds, thousands, and of other people looking for signals. So other people come across it, and everyone starts doing the same thing. And so the alpha fades over time. There's just too much capital that has found and trying to take advantage of the same inefficiency, which then ceases to be an inefficiency, right? So the signal decay really is a function of chasing capital, or large capital chasing signals, and everybody eventually finding the same stuff. That's inevitable. Right. So that defines that side of the issue. Now we come to the other side of the issue where, per my tweet, I say, it's not always seeking new, but digging deeper in what you're familiar with. What I mean there, of course, in Twitter, you only have 140 right. characters or whatever to say what you want to say. So it's very generalist, right? And you can't get into describing exactly what you mean. But so what did I mean there is that even those signals that decay, or somebody found something, or there was something that one was looking for, right? In the research process, somebody believes that there's some inefficiency, and they start digging in a direction, and they become familiar with that direction, right? Let's just say, I don't know, I'm trying to think of an example where in StatArb, let's say there's the Coke Pepsi example I spoke about earlier, mm-hmm. right? So people could look for a signal, and they're using some mathematical process to say which pairs have been trading together for a while and then diverging, and then too many people are doing it, so it stops working. But that doesn't mean that as a stat arbitrageur you should say, okay, now let me look over at ConvertArb, right? Or now let me look over at relative value trade or some other completely different space. Now let me get into crypto trading. My point is, stay in StatArb. Just look at different angles. For example, what I do is, instead of going mean reversion, I'd say, hey, look, in every StatArb portfolio, there's a bunch of pairs that keep on blowing out wider. What about the mean expansion side of things? That's digging deeper into the same area, right? And it's just saying, hey, how can I approach this from a different angle? You already know what you know in that area. There's a lot of accumulated knowledge. So instead of throwing that all out because that signal's decayed and say, hey, let me now go learn a whole new book, rather let me lean on all the chapters I know and add a new chapter. How can I rethink what it is that's happening here? Even if I wanted to stay in mean reversion, okay, so I approached Coke and Pepsi from this type of model. Maybe there's, are there other markets I could apply the same thing to? Maybe that process works in European markets. That would be digging deeper on something So that's really what I'm saying is, from my experience, I found that when something starts to decay, I inevitably or usually find another pocket of alpha around that accumulated knowledge of that thing, rather than just stepping out and saying, "Oh, I give up. I'm going to something new."
And this, I'm glad that I asked you about this, and that was a fantastic answer because, for our listeners' sake, for example, and I know a lot of our listeners are also readers of, Stansberry researches, like, dozens and dozens and dozens of different newsletters with all kinds of different ideas. And yet, this is almost like the appeal to keep it personal, stay within what you understand and what has worked for you. Maybe it's not working precisely the same way, but don't go too far afield. And if you're really thinking about it, really sticking to your guns, maybe what you've been doing that isn't working will naturally lead you to, maybe flip it upside down, or see it in a new way. I think that's a really great thing for you to tell us, if I understand it correctly.
Yeah, in fact, I'm over here on my desk. It's funny. I have this quote. It sits on my desk right here next to me. It's one of my favorite quotes. So I'm going to read it. It's from Marcel Proust. The real voyage of discovery consists not in seeking new landscapes, but in having new eyes.
Right.
So along the same lines, right? Just it's like we don't even need to travel. We could just look at the same location differently.
That would be a radical interpretation of that, but who knows? Given
Yes, of course.
Right.
I'm just, to make the point, of course.
And yet, given how we've been, kind of locked down for a good part of the past 2 years, that's a pretty valuable insight, I think. Could have kept you from going stir crazy.
Yeah, there are parts of our house that we never knew existed.
There you go. Yeah, right. So, Wayne, I'm wondering, as I think about the type of events that really, prove your concept and make your strategy shine, they, arrive at all kinds of, under all kinds of circumstances and all kinds of markets, and you never know what the headlines are going to be, and you just never know where it's going to come from, and it makes me wonder, how much attention does Wayne Himmlestein pay to the headlines and to what the Federal Reserve says it's doing, or is actually doing, even?
Yeah, the broad answer is not much. Headlines. Yeah, I don't watch CNBC. I don't read headlines. I don't. People have told me way too often that really, you don't know what's going on, and I really don't. That's not where my focus is. There's only so much time in the day to focus on things and to learn and to grow our minds on stuff. So I grow my mind on stuff I care about, and I would rather all day long read another interesting white paper or dig into some concept I'm working with, rather than read headlines, because I find that every day it's effectively, or every month or every year, it's the same headline.
Yep.
Just take out the country name, replace with another, right? And XYZ suffers. Yes, that happens. That's going to happen. That's the way of the world. And I don't mean to minimize it. I'm a caring person, of course. I care about what's happening in the world from a human perspective. But how it affects the markets, I find the markets tell me that. And I find that the alpha sources we look for shouldn't rely on what's happening out there, because the next thing that happens won't look like the last one. So if I rely on the prior one for a behavioral characteristic, I'm going to fall short the next time. And so I want to build something that's not reliant on what the specific headline was, that's robust enough to be agnostic to the type of event. And therefore, I don't want to know the type of event. I just want to build something that behaves in the right way most of the time.
I think I might go farther than you, although I understand the point about not wanting to suggest that you don't care what's happening to other human beings in the world. I get that. But I would go farther. And I would almost say that the extent to which you can avoid, let's say, the overwhelming majority of news is it's directly proportional to your ability to compound real useful knowledge over time, I would say. I don't think that's unfair at all.
I mean, it's just noise, right? There's a lot of noise out there, and compounding real knowledge necessarily means removing the noise, right? knowledge is signal over noise, right? So if you want signal, ignore the noise and you'll get more signal or you get a better signal to noise ratio.
Yep, I think that signal to noise. I often think of trying to learn anything as kind of a mining operation. You've got a ton of earth for a half ounce of gold or something. So you that separation. Yeah,
Totally,
yeah.
totally. And it's actually, yeah, absolutely. And so much so with investing, I have a lot of people come to me at different times with different investment opportunities, and I ignore them. I'm not interested. And I had, just 2 weeks ago, a friend of mine was telling me about something I'm not interested in. He's like, "You're always not interested in these things." I'm like, "Well, I don't understand them enough. Like, why would I risk capital on something that I don't totally understand?" Right. And so, and people look at it, oh, so you're totally concentrated? Yes, I'm concentrated in my accumulated knowledge.
Right. And where else can you be? Where else can one be effective? I mean,
right.
In fact, you address
right.
Sort of the answer to that question and the mistake people made in there's a white paper on your website, and I had it in front of me, but the title I thought was kind of interesting. It's a topic. It's called "The Illusion of Skill." And there's a lot of complicated
right.
Math with funky foreign characters in it that people like me don't get. But this idea of the illusion of skill,
yeah.
separating skill from luck, has become. I certainly, when I grew up and went to college, I mean, nobody ever talked about any of this. Maybe they did in finance, but in nowhere else. And now we talk about it in a lot of different disciplines and occupations and things. Maybe you could tell us in a way that folks like me would understand. What have you learned about the illusion of skill? I know your paper is about evaluating hedge fund returns, but what was that paper about? What was your insight
There's
there?
so much to say there. Yeah, there's just so many ways to answer that. Let me think of the best. I mean, the illusion of skill is that obviously, let me use an easy example. It's easy to look like a good trader in a bull market, right? And so, you get a lot of these traders, and it's buy on dip. Sorry, and I said buy on tip. I'm buy on dip. I guess both things. So buying on tips or dips, either way, is you can get these upside results that, hey, I'm great, or I get great tips, or I buy on good dips, right? And the market rewards you for that. And of course, it's been consistent, or it's been enough of a bull market over so many years that it starts to give you the illusion of skill, right? And it's hard to say otherwise, because people say, well, that's what the market does. It's resilient. It comes back. And so we just buy the bottoms. And yes, that's true a lot, but there's been long periods of markets where that has not been the case. All right. And it can go on, bear markets can go on for years. And it's hard to keep on saying that story, or that narrative fades as the bull market continues. But the point is that it can look like skill, where really somebody's just buying in a bull market. So how do you assess that versus somebody who truly has skill, and they will do well now, and if the market should turn, they will continue to do well, right? That's the key point, is how do you differentiate the two? And really, we found that we can do that mathematically in the shape of the distribution. And this has a lot to do with what's called skewness, which is a distribution that has a fat tail in one direction or the other. And if you use an example of long vol, which is what we do, long volatility is a more right skewed, versus short volatilities can be more left skewed, or markets can be left skewed, can be negative skewed. They can go up for a while, and then it could be this big event that takes you down aggressively, a big magnitude drawdown very quickly. The easy example is COVID, right? So you're making money in bull market, you're buying on dips, and then S&P cracks 5-10%, you buy that dip, and then that floor falls right from under you, and there's another 20% downward move that takes out your entire portfolio, right? That's the negative skew event, that where all the previous dips you bought, the floor didn't fall, this time it did. And so the illusion has broken. You didn't have skill, you were just buying a risk. Whereas, for example, in long vol, use the example of us, where we're buying puts against the S&P, being effectively short the market while it's climbing, but making money along the way is, well, how do you do that? That's more, in my view, skill-based, because you're literally going against the grain and you're making money, right? And then COVID happens, you make more money because that's the payoff you've been waiting for. So that seems harder to assume that as illusion, because it's very hard to do that. Like, no, it's hard to argue with that. How do you do that? And so there's, of course, the common sense where people can look at that and say, yes, that seems like it'd be hard to do, to stay short and make money while the market's climbing. That must be skill, people would say, right? Thinking about that usually, right? And so you could look at that as common sense, or you could look in terms of the shape of the distribution and say, oh, if somebody's more positive skewed, they tend to have a skill and have these upside payoffs, versus a negative skew is someone who's taking too much risk with a pending crisis on the way. And that illusion will break when that event happens. Therefore, it wasn't skill while you were waiting.
Yeah. And, this topic calls to mind, like, I fear there's a whole generation of very small, we might say thinly capitalized, but small retail investors who have huge positions in things like Tesla and AMC and GameStop. And, whether they ever learn these terms, boy, are they going to learn, the meaning of it in their lives and in their investing.
Yeah, what's interesting for me, what had such a big impact was being at the tail end of the dot-com bubble, right? So when I started trading in the mid-90s, it was one of these raging bull markets. And 99, I remember, was one of the best bull years ever. The NASDAQ was up like 75%, right? It was just incredible. And I remember making a ton. And then all of a sudden comes March of 2000. And I mean, all of these names across the board, everything that was .com, and names that were at $300 a year later were at $2, right? And not just one of them, but dozens and dozens and dozens, and all of them. And it's like there was no floor, right? And it ended in such a blow that I think having that happen to me and seeing that early on in my career really just crystallized this concept, and that we have to, and that I had to understand the difference between illusion and skill, right? Or what was illusion and what was skill. And maybe, partly, I was already, kind of long vol positioning, but it just further crystallized how powerful this idea is, to see that is what somebody's doing actually alpha, or is it just what I call risk transfer, which is alpha that will one day be ripped away from them.
Right. Alpha that will one day be ripped away. That's what it looks like to me. And given my bent is, to look at fundamentals, and given what's the reality of the industry and the particular business, in GameStop and AMC, the valuations, like, they've come way off, but they're still way too high. It just, and
sky high.
So many people have so much conviction about it, though. Very much like, the internet's going to take over the world, buy whatever it was back in the day, JDS Uniphase, and you'll never lose money,
Right. But the irony is that both can happen, right? The internet did take over the world, but JDSU is still, what is that, $1, right? So both things are independent.
And
right.
That's right. The bubbles, I think it was maybe Galbraith or somebody, the bubble is rooted in truth, right? It's valid.
Right.
But it doesn't mean you're going to make any money.
Right. Right. Or it doesn't mean that company will continue to lead that for the rest of time, or for that much longer. So that's the issue, of course. And it's so hard to not only differentiate, but it's so hard, I find, I have a lot of conversations with young traders and who get very emboldened by early success, or kind of buy the dip success. And it's, I don't want to be the naysayer in the room. So I'm like, oh, that's great. And, just make sure you watch out for, I put in my subtle years of experience but it has, people have to learn it. And over time, markets teach them. That's the best thing I can say. It's almost unescapable.
What's interesting to me, Wayne, is that I've interviewed probably, a couple hundred people must be on this podcast over the past couple of years. And the story of my career started around the time of the dot-com boom, and I got wiped out. And the next thing that I usually hear is, I learned how to think about valuation better, and I learned to spot better companies and not buy garbage and all this stuff. That's what I hear actually from everyone but you. Everybody else says I learned what to buy, and you're like, I learned how to exploit these enormous, negative events, which I find very cool. But have you always had a contrarian bent? Were you a hard kid to be a parent and teacher to when you were young?
Absolutely, yes. I was the skeptic, and I was once told by a teacher why I asked so many questions. Can I stop asking so many questions? And I'm like, well, what? I can't just listen to
Right.
what you say. But yes, yes, I actually got in trouble for that and was asked to be quiet. Right, and it's not like just for not. I'm not talking. I'm not talking to my buddies. I'm asking genuine questions, but it was too much for the teachers who wanted to just teach what they wanted to teach, which I understood. But yes, I was always that kid, and I guess it's funny. I don't know if I'd call it a contrarian bent, because I feel like it's more just relentless questioning or skepticism to some degree about why should things work the way they work, and who says that this should be the way it is. And it's just a sense of wonder and curiosity really has driven it.
Right. Yeah, it reminds me of Richard Feynman and his emphasis on true understanding. If you don't truly understand it, and you just have formulas memorized, and you're doing like, he had that bit about the cargo cult, cargo cult science.
Absolutely. That's such a great paper.
Yeah, Wayne Himmlestein is not a cargo cultist. He's the genuine article, folks. So we've been talking for a while here,
Yeah.
and it's time for my final question, which is the exact same question for every guest, no matter what the topic, even if we're not on a financial topic, and you don't have to answer. It doesn't have to be a finance-oriented answer. Any answer, whatever's on your mind. And the question is simply, if you could, you have a chance here to leave our listeners with a single thought today, and what would you like that to be? Yeah.
Wow. All in a single thought, to collapse all possibles into a single thought. That's tough. I'm going to go with what it is that we were talking about. I mean, what you just said about Feynman. I love Feynman. I love all of that way of thinking and kind of the curiosity for the world. Half of what we've said today, you pulled up the tweet earlier about digging deeper. The thought, therefore, I leave everyone with is just ask more questions and don't accept what's said or what's written. Think about things from different angles. We talked about turning upside down, from reversion to expansion, right? Look at things differently. It's the Proust quote of seeing the same land with different eyes, right? All of that is just think more widely about stuff and ask more questions, and don't accept what is in the media, in what people say, and I just always think about what am I not seeing, and I guess have a drive to learn and know. That's what served me the most in my life. That's what without that way of thinking, I certainly would not be where I am. And I see other people just kind of get into grooves and do the same old thing, and not sit back and either ask why or want to dig deeper or challenge further, and get into trouble later on. I've seen that happen over and over. And so I want to leave with people, don't let that be you. And it's not difficult. It just starts with asking more questions, and deeper digging. And usually you'll find something more interesting and go down different paths that you never might have. So that's my, I guess, final thoughts or final words of wisdom, if you could call them that.
I would call them that. That was great. Thank you for that. And thanks for doing this, man. I really appreciate it. I know I learned a lot, and I'm sure our listeners did too. And I hope maybe in, 6 or 12 months or something, we can check back in with you.
Yeah, no, it was very nice. Thank you for having me. And it was a pleasure.
All right. Thanks, Wayne. Bye-bye for now. Well, as we often say here on the podcast, I hope you enjoyed that as much as I did. As I said, Wayne is he's a very different kind of investor. I mean, he's sort of on the other side of everything almost everyone does. And I thought of all the people who, all the quants and things that I maybe either follow on Twitter or have met at conferences over the years or just know, he seemed to be the one who could really talk to us in plain English better than, 99% of them. So, and I thought he did a great job of that. And by all means, check out, logicafunds.com. There's some more of the same there. And I'm telling you, the real thing to do is follow him on Twitter if you like what he had to say, because that is where he puts his best, sort of plain English nuggets about what he does. All right, that was great. Let's check out the mailbag. Let's do it right now. Gold just passed $2,000 an ounce, setting the stage for a historic new bull run. Multiple billionaire investors are loading up on gold, including hedge fund founder Ray Dalio and real estate mogul Sam Zell, meaning now is the time to own gold. One precious metals expert is stepping forward with a big prediction. He believes we could see gold reach as high as $3,000 by the end of the year, possibly higher. Find out why and get instant access to his number one gold investment for 2022. It's not bullion, an ETF, or a mining stock. In the past, folks using this same gold strategy could have been able to make nearly 50 times their initial investment. Considering how quickly the price of gold has been moving, you don't want to waste any time missing out on the gains he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to www.goldmania2022.com. Again, that's www.goldmania2022.com for a free copy of his new report. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. Or you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. We have two emails from Logica H this week, our faithful listener and frequent correspondent. And the first one, Lodovic says, I have some questions. What do you think about the sanctions against Russia? Is this not the perfect moment to acquire Russian stocks, mainly resources and military-industrial complex? Lodovic, I'm going to answer that one right away. I have thought Russia was uninvestable for some time. And you just never know. You never know when any government is going to just decide to pull a fast one on you and seize a bunch of assets or raise taxes or do whatever it's going to do. But Russia has been, I think, more capricious than most. So to me, it's uninvestable. Lodovic H's next question, his second one. Hi, Dan. Regarding the market and what is happening in the world, is it not best to exit, sell everything, store it in silver, gold, optional Bitcoin, position yourself for the market crises/crash? And to buy for pennies on the dollar when all hell breaks loose. Lodovic, I don't see the necessity of selling everything in order to position yourself for a crash. So my answer is, no, don't sell everything. But yes, you can position yourself for a crash. You can own silver and gold and some Bitcoin maybe. And maybe you can own a few, out of the money put options on the, S&P 500, maybe the NASDAQ, definitely the NASDAQ, maybe the Dow Jones Industrials, maybe the Russell 2000. You can position yourself for a crisis, and you can also, you don't have to buy puts. You can just hold plenty of cash. That is really the best way. That and holding gold and silver, if you have plenty of those three, you're positioned for a crisis. So no, I don't think you need to sell everything. Yes, definitely positioned for a crisis. Finally, this week, Kevin D writes in and says, Good luck with Moby Dick. It's a 500-plus page whale anatomy lesson masquerading as a revenge tale. I broke my streak of reading every book I started cover to cover. After halfway through, I started skipping every chapter unrelated to the main story. Kevin D. Well, Kevin, I want you to know I have no problem not finishing books that I start. I've not finished most of the books I've started. I'm a world-class book starter, but I don't think it's necessary to finish. The time of your life is precious. And you all may remember, just in case you don't, last week I said, you should read some fiction, and I had Moby Dick that I had read the first few pages of, and I thought, okay, maybe I'll give this a shot. I haven't given it a shot yet, but I feel like Kevin's challenging me here, so maybe I'll have to do that. I do still believe that reading fiction is really important. And like I said, it's the things you learn from it, you don't know you know them until you call upon them. It's strange to me how that's worked out for me. And I think I'm going to guess it's worked out like that for other people. Because you read fiction because it's pleasurable, it's fun, it's interesting, and then one day you realize you learned something from it because something happened to you and you called upon this knowledge that you picked up from some work of fiction. At any rate, thank you, Kevin D. That's it for the mailbag, and that's it for another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might enjoy it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts, and while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. If you have a guest you want me to interview, drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.